Welcome to 2023 and the year of the rabbit. This is the first managed discretionary account update for the year, having a look at the month of December and also the progress we've had so far in January this year. So we had our first committee meeting on Wednesday where we, as always, had a robust discussion about the current economic environment, where the portfolio is at and any potential changes that we're going to make. With regards to economically, we've had some interesting signals in December and certainly so far in January, with the inflation figures in the US probably being a little bit less than expected, but in Australia, which was announced on Wednesday, that the inflation figures were higher than what the expectations were. What we've seen so far, with that underlying economic inputs with regards to the US, particularly I guess with the banking sector, we've seen some softness in the banking sector. We've seen some technology companies and other companies starting to make retrenchments in order to improve their earnings outlook by obviously cutting their costs because the revenue line is under pressure, and we think that's obviously something that's going to continue throughout 2023. There's no question that the interest rate rises are starting to impact consumer spending. In Australia, we've seen a significant drawdown in people's savings buffers, and so those buffers have come off a lot, and certainly would expect them to come off more significantly in the next 6 months. So the way we're sort of viewing things economically in 2023 is that it's probably going to be a pretty reasonable first 6 months of the year, first 3 to 6 months with regards to earnings for companies, and certainly from a stock market point of view, but certainly that potentially is going to come under pressure in the second half of the year, which again obviously is what you would expect with the interest rate rises that we've had so far. In regards to the portfolio, we had the month of December from a stock market point of view was pretty negative. We were still defensive for most of the month, only moving to a more neutral to sort of positive stance late in the month, and that's worked in our favour. So we didn't cop too much of the downside in December, but certainly been able to capture a lot of the upside since the start of the year, with equity markets being strong. So we changed the portfolio to have more exposure to both Australian and international equities late in December. We also, made some changes in terms of pulling some money out of private equity and moving that towards equity focus, and then also we moved a little bit of money, little bit of money that we had out of gold back into sort of more growth orientated investments. And while that gold sort of exposure has continued to run, we're pretty happy with the change to more of an equities focus. With regards to the fixed income part of the market, we maintained the focus on floating rate notes, and again, floating rate notes benefit from increases in interest rates, and certainly the expectation is, with inflation figures here and particularly in New Zealand as well, showing better than or more than expectations, that you would expect some further interest rate rises, and perhaps we think there's another couple of interest rate rises, perhaps in February and March, then stopping after that and waiting to see sort of what impact it has on the economy. So broadly, we're really happy with the changes we've made in the portfolio. We think it's obviously provided some good benefits to clients with that exposure, and we're going to continue to see that. And we sort of think perhaps over the next month or two coming through earnings season that the market's continuing to perform, and then we may be looking to make some changes, perhaps adding some fixed rate notes to the fixed interest component, and maybe just sort of adding some focus in terms of earnings production in regards to the equities component. So thank you for taking the time to listen to the video today, and we look forward to providing more updates throughout 2023.